Welcome to the Discovery Clock series. To better understand how a conservative Swiss bank ended up owning one of the most aggressive firms on Wall Street, and how that very firm would ultimately become the architect of its collapse, we have to go back to 1933, right into the wreckage of the Great Depression.
Conveniently at any time. I can assure you, my friends, that it is safer to keep your money in a reopened bank than it is to keep it under the mattress.
It was panic. 16.5 million shares of stock sold in a single day. Sold hopelessly, desperate, at any price.
In 1933, in the wreckage of the Great Depression, Congress passed the Glass-Steagall Act. The law was a direct response to the 1929 crash, and its logic was simple. Commercial banks, the institutions that held ordinary Americans' deposits, had been speculating in the securities markets with that very money. When the markets collapsed, the banks collapsed with them, and millions of people lost their savings. The Glass-Steagall Act was designed to ensure that could never happen again. It drew a hard line between commercial banking on one side and investment banking on the other. No institution could do both. And so, on the 27th of June 1932, in anticipation of the law's passage, the investment banking arm of the First National Bank of Boston was separated from its parent company and established as an independent entity, the First Boston Corporation. The main commercial bank continued on its own path, eventually becoming part of what is today Bank of America. But First Boston would set out to build something entirely different. Indeed, in its early years, First Boston would absorb talent and businesses from other institutions forced through the same separation. But this would push the firm towards the higher margin, higher risk business of advisory work, underwriting, and eventually towards mergers and acquisitions, the very activities that would define it at its peak. By 1970, First Boston was considered part of Wall Street's bulge bracket, the small group of elite firms that dominated the most significant transactions alongside Morgan Stanley, Dillon Read, and Kuhn Loeb. That same year, the firm would raise more than $10 billion in new capital annually for its underwriting clients. That forced appetite for risk perfectly positioned them for the 1980s. For decades, First Boston had simply been waiting for the right environment, and when Ronald Reagan took office, that environment had finally arrived.
With tax reform, America will have the lowest marginal rates and the most modern tax code in the industrialized world, one that encourages risk-taking, innovation, and that old American spirit of enterprise.
As the 1970s gave way to the 1980s, the global financial landscape was in the middle of a fundamental shift. Deregulation was sweeping through markets in London and New York. The old stately pace of institutional banking was giving way to something faster, louder, and far more competitive. Investment banking was no longer a gentleman's profession. It was becoming an industry, craving for something bigger. At the centre of it all was Washington. When Ronald Reagan took office on the 20th of January 1981, he came in with a clear philosophy to get the government out of the way and to let the market do the rest. He began by cutting the top marginal income tax rate from 70% to 28%. He then adopted the Gans-Saint-Germain Act of 1982, deregulating the savings and loan sector, and the Tax Reform Act of 1986, subsequently reshaping corporate borrowing incentives in ways that poured fuel on the leveraged buyout boom.
Government's view of the economy could be summed up in a few short phrases. If it moves, tax it. If it keeps moving, regulate it. And if it stops moving, subsidize it.
Wall Street discovered that you could buy a company not just with the cash that you had, but with the debt you could issue. Michael Milken at Drexel Burnham Lambert turned high-yield junk bonds into a $200 billion market by 1986. The hostile takeover, the leverage buyout, and the corporate raider were no longer just fringe activities. They were becoming the defining economic events of that era. In 1980, the total US merger and acquisition activity stood at around $44 billion, or $177 and $83 billion in 2026. By 1988, it had climbed to $246 billion, or $692 and $50 billion. American culture reflected this need for a bigger, better, and more extravaganza opulence, all without apology. And during that period, Oliver Stone's Wall Street film would arrive in 1987, giving the world Gordon Gekko as a cautionary figure of greed.
Ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much.
Stone naturally meant it as a warning, but a significant portion of Wall Street took Gekko's greed to heart, and as the foundation of a new business philosophy. By the 1980s, First Boston's Merge and Acquisitions Department had become the engine of the firm. A 1985 Fortune magazine article called it the archetypal deal factory. A year in which it completed $60 billion in merger transactions, placing it second only to Goldman Sachs. The Texaco hostile takeover of Getty Oil, the leveraged buyout of Federated Department Stores, which alone generated $200 million in fees. First Boston was everywhere that mattered, and the men responsible for this new wave of success were Bruce Wasserstein and Joseph Parella. Wasserstein, known in the industry as Bid 'em Up Bruce, for his tendency to push clients toward the most aggressive valuations the logic would support, and Parella, his more methodical counterpart, had together built First Boston's merge and acquisitions practice into a force that clients came specifically to them because they wanted to win. We were the hired guns. When a company came to us, they wanted to know one thing: how do we win? And we told them. But by 1987, the internal politics of the firm had soured. Wasserstein wanted the management committee to redirect resources toward his merge and acquisitions unit from bond trading, but they refused. And so, in February 1988, he and Parella walked out entirely, taking their reputations and their client relationships with them to found Wasserstein Parella and Company. Their departure left the firm in a genuinely difficult position. The franchise they had built was, in large part, walking out the door with its architects. But what happened next would make things considerably worse for First Boston. First Boston's leadership, under Chief Executive Peter Buchanan, had been leaning heavily into the leveraged buyout business. So, in 1988, the firm provided bridge financing for the buyout of the Ohio Mattress Company, the manufacturer behind the Sealy brand. First, Boston committed $457 million, a figure that represented roughly 40% of the firm's entire equity capital. The logic was standard for the era, and it meant holding the bridge loan briefly, selling it into the junk bond market, and subsequently collecting the fees at the end. The whole cycle was supposed to only take a matter of months, But this time round, it never happened.
After last Friday's record 108-point loss, analysts had expected a rally. Instead,
it's a panic. Everyone's in panic. Everybody, we're trying to find a bottom. We're trying to, as a floor broker, I see stocks trading 10 points below where they traded Thursday, and I'm saying this has to be the bottom. And then they trade 5 points lower than that.
By noon, the market was down about 150 points. The tape delayed by more than an hour. But it only got worse.
And so, in February 1990, the cards on Wall Street began to topple one by one. Drexel Burnham Lambert, the firm that had thrown into motion the junk bonds euphoria, ended up filing for bankruptcy. The junk bond market, already weakening through 1989, effectively froze overnight. No one was willing to buy anything. First Boston was thus left holding $457 million in loans it could not sell, on a deal it could not exit, and in a market that no longer existed. The position greatly threatened the firm's solvency. On Wall Street, their transaction had acquired a nickname: the Burning Bed. Peter Buchanan was left with no good options. He turned to the one partner, at the time, with the resources and the motivation to help. In October 1988, that partner would be Rainer Emil Gut, the chairman of Crédit Suisse's board of directors. Rainer Gut and Buchanan had already formalized a deeper relationship. Indeed, in 1978, Crédit Suisse already had a 44.5% stake in a newly private joint venture, with First Boston's management retaining 25%. But to understand why a notoriously conservative Swiss bank would tie its fate to a collapsing Wall Street firm, we have to understand the man making the decision. Who was Rainer E. Gut? Rainer Emil Gut was not your typical Swiss banker. Born in 1932 in Bar, a small town near Zug, his father was a bank director. Finance was the family business, but his trajectory would look nothing like what his strict traditional upbringing suggested. In 1956, while living in Zurich, Gut met Josephine Lorenz, an American former photo model from Detroit. They would marry a year later in his hometown of Bar, and that American connection would eventually become one of the defining moments in his life. Indeed, shortly after getting married, his career would take him across the Atlantic. Union Bank of Switzerland, or the bank we now know as UBS, had sent him to work in New York. Gut served as a crucial New York liaison for the top executives shuttling back and forth from Zurich. He was young, effective, and deeply ambitious. But when the time came for a major promotion, the rigid Swiss institution passed him over, and this would end up being a turning point in Gut's life. Feeling sidelined by the Swiss bank, Gut would later join, in 1968, the elite American investment bank, Lazare Frères, as a general partner. And for the next 3 years, Gut would be immersed into the sharp, aggressive, and highly lucrative world of Wall Street deal-making. He would live through its rhythms, its culture, and its incentives. And his unique dual perspective did not go unnoticed. Indeed, in 1971, SKA, or Crédit Suisse, would poach him from Lazare Frères, asking him to run their own New York-based investment banking arm, known as Swiss American Corporation. Gut had managed to become the rare executive who understood simultaneously the cautious halls of Zurich just as well as the cutthroat trading floors of Manhattan. What Gut saw in America was a financial industry that had found a fundamentally different way of generating wealth. not through the patient accumulation of assets under management, nor the careful stewardship of inherited fortunes, but through merger advisory mandates, equity underwriting, leveraged buyout, and fees that arrived in weeks rather than years. It was aggressive, it was competitive, and it was producing returns that Swiss banking could not match. Gut eventually returned to Zurich, joining SKA's executive board in 1973, becoming its spokesman by 1977 and chairman in 1982. He had observed the Chiasso scandal and believed that a bank dependent on a single model, that is, Swiss discretion, steadiness and secrecy, was more fragile than it appeared. In Gut's mind, America's cultural finance was the answer, and he was convinced that Crédit Suisse needed to become part of it and adapt to it. Traditional Swiss banking was stable, but it was not generating the returns that Wall Street was producing. Gut's goal was to build a genuine global Swiss investment bank capable of competing with Goldman Sachs and Morgan Stanley. But in order to do that, he needed an American platform with an established deal flow, seasoned talent, and a brand that Americans already trusted. By 1988, the opportunity he had been waiting for arrived. First Boston's catastrophic $457 million investment in the Ohio Mattress Company had pushed the firm to the brink of collapse. Because of this debacle, Crédit Suisse's joint arrangement with First Boston was becoming too difficult to hold on to. And so, in 1990, Crédit Suisse was subsequently forced to inject an additional $300 million into First Boston. It therefore ended up taking a controlling stake that would eventually exceed 60%. There was an uncomfortable irony embedded in this rescue that few people mentioned at the time. The safety arrangement between Crédit Suisse and First Boston was arguably in violation with the Glass-Steagall Act of 1933, the very law that prohibited such fusions, and the one that had created First Boston in the first place. A commercial bank, Crédit Suisse, was now the controlling owner of an investment bank. But why was such a fusion even allowed, if it was illegal? Well, to put it simply, the Federal Reserve, the US bank regulator, had quietly concluded at the time that avoiding the bankruptcy of a major Wall Street firm served the public interest better than enforcing the letter of the law. The separation that Glass-Steagall had mandated in 1933 was, in practice, dissolved. It would take until 1999 for the law to catch up with reality. That very year, President Bill Clinton would sign the Gramm-Leach-Bliley Act, a legislation that formally repealed the Glass-Steagall Act and made permanent what the First Boston rescue had already made true. Commercial banks could now own investment banks. The wall erected in the wreckage of the 1929 crash was officially gone.
It is true that the Glass-Steagall law is no longer appropriate to the economy in which we lived. It worked pretty well for the industrial economy, which was highly organized, much more centralized, and much more nationalized than the one in which we operate today. But the world is very different. Now we have to figure out, well, what are still the individual and family and business equities that are still involved that need some protections? And the long and often tortured story of this law can be seen as a very stunning specific example of the general challenge that will face lawmakers of both parties, that will face liberals and conservatives, that will face all Americans as we try to make sure that the 21st century economy really works for our country and works for the people who live in it.
Crédit Suisse owned the firm. The new entity would be called Crédit Suisse First Boston, and it was about to discover what that truly meant. Indeed, this would mark the beginning of a long and painful fall for Crédit Suisse. Hello everyone, thank you for watching the video and for your patience and support. Please consider subscribing and sharing the video, and as always, see you in the next one.